All right, thanks everyone. Our next session is focused on tokenization. My name is Anthony DiMartino. I'm the CEO and co-founder of Centura. What we're going to discuss today, and we'll get into the introduction very briefly, is tokenization is a big meta. We've seen rapid growth over the last couple of years. We're seeing better use cases and more investable reasons for tokenization, and we're seeing some that are falling off to the wayside. So we have Charles here from S&P, Maria from Electric Capital, and Arian from CMT. So you guys want to just go really briefly into your backgrounds and we'll get started?
Yeah, sure. Hi, everyone. My name's Arian. I work as the head of research and as an investor at CMT Digital. CMT Digital is a Chicago-based blockchain VC firm. We are the blockchain investment arm of a larger proprietary trading firm. We're on our fourth venture fund. This one's about 136 million to continue supporting projects in the space. Really looking at the intersection of TradFi and crypto DeFi right now, as that's where most of the opportunity lies. I've been with the team for about 5 years. I got my start in crypto back in 2017. I was at the Blockchain Research Institute during my time at Columbia University. Never wanted to work in any other space, so it's a pleasure to keep doing this.
Hi everyone, my name's Maria. It's really nice to be here. I'm a general partner at Electric Capital. Electric Capital is an early stage venture firm. We invest at seed and Series A, anywhere from $1 million to $20 million. We have $2 billion in assets under management and invest across DeFi, layer ones, anything that kind of falls within this idea that we're building a parallel financial structure. And prior to Electric, I was working on my own company. Prior to that, spent some time at Microsoft. My background is mainly in engineering and in product.
Hi everyone, my name is Chuck Mounts. I'm the Chief DeFi Officer at S&P Global. So as you know, S&P Global is the world's largest rating agency, the world's largest index provider, and the world's most important commodity price provider. We, in essence, provide the data analytics and benchmarks that support and power market functioning. My team, the DeFi team, was established about 5 years ago, and the mandate of my team is to help ensure that we build the products and services and provide those products and services in a digital asset marketplace to enhance liquidity, enhance transparency, and enhance price discovery, fulfilling a similar type role in digital asset markets that we do in traditional markets.
Perfect. So we're going to go with a little jump ball format. So the first question, whoever wants to take this, is tokenization in general, should we do it, why, and which assets?
So from our perspective, I think yes, with some caveats. I mean, we shouldn't look to tokenize absolutely everything for the sake of tokenization, but we think that there are specific functions that are more useful as a result of tokenization, or become possible as a result of tokenization. So we think tokenization makes sense when it increases access, or when it increases utility, or if it makes something multi-venue, or if it increases the surface area of what that asset can do. If it couldn't before act as collateral, now it can. We think those high velocity, the higher velocity potential the asset has, the more susceptible to tokenization we think it can be. So that's the sort of framework that we look at, velocity and appetite.
Before we go to the next, can I jump in on access? What does that mean to you? Because I have heard the tokenization for fractionalization, tokenization to, for lack of a better term, get around U.S. investor protection laws, or offering assets, U.S.-based assets to people in other countries. So what's access mean for you?
I mean, I think access can mean many things. It can mean US dollar access through stable coins, but it can also mean access to a more diversified collateral base than you would have otherwise had access to, or access to illiquid shares that have now become more liquid as a function of tokenization, and therefore make increasing the access for a wider variety of funds that may have been out of mandates previously because of the liquidity constraints.
I think access can also take a variety of forms. So when you talk about a developed economy or kind of the developed economic infrastructure, access has a whole different meaning, i.e. institutional versus retail. But when you go to a global lens, and you talk about people who live or companies that live in very tightly capital-controlled economies, getting access to US dollar assets and US dollar earning assets is really revolutionary. And so there are many places around the world that, that having access to these type of yield products that they never would have access to historically, whether it's the S&P 500 or anything else, is a whole new floodgate of opening access to really elevating access to financial products and return potential and lifting people out of poverty, potentially out of poverty around the world, way outside of the scope of working in just a developed economy context.
I mean, just a personal anecdote. I'm Persian. I was born in Iran, and my family lost a lot of their life savings as a function of the Toman depreciating throughout my lifetime. If they had access to stable coins, it would have been a completely different environment.
Maria?
I think eventually it feels inevitable that everything will be tokenized. I think there is a question of how much demand do you have for your tokenized assets. And so to me, it's not a question of if things will be tokenized or whether things will be tokenized, but rather what is the right timing for certain things to be tokenized. I certainly think anything that can provide real uncorrelated yield on chain right now is incredibly interesting. We have over $300 billion in stablecoins now, and it's unlikely that, or rather it's of course undesirable for people to just hold these dollars without earning any form of yield. Unfortunately, most yield on chain is either treasuries or it's completely correlated with crypto prices. And so, I think any type of tokenization that can bring interesting yield products on chain is fantastic. But there's a very deep rabbit hole, as I'm sure everyone has thoughts to, in terms of what is the right timing for different types of yield-producing assets.
So in thinking about tokenization, I agree with Maria that tokenization of everything, I think, is going to happen. But predicting the full range of use cases sitting here in 2026, I think, is almost a fool's errand. And I'm reminded, for the people of you who were here when the internet was invented, going back 20, 30 years ago, you couldn't have imagined at a future date you're going to click at your work desk and your toothpaste is going to show up at your door at 2 o'clock that afternoon. Like, there were so many iterations that went beyond that initial phase, and I think that's what this is. As market rails get completely transformed, there is going to be the second derivative, the third derivative, the fourth derivative that we can't even imagine right now. But the thing that we can imagine around tokenization, and that gets me excited and thinking about it from an S&P lens, is the ability for portfolio construction that can blend crypto-native assets with tokenized real-world assets to create completely unique and bespoke portfolios that have a unique risk and return attributions, and integrating types of assets that have never really been easily accessible before into portfolio construction, which can include things like intangible assets. So when you think about, like, we're the world's biggest index provider, you think about creating an index product, for instance, of the revenue streams from the top 10 pop music producers, the top 10 country music producers, and access to their tokenized revenues, to their IP stream from their concerteurs and record labels, and turning that into an index product. I mean, that's a kind of product that has never really been possible before. That tokenization makes it a possibility. Now, we're not anywhere near that, but just one example of integrating intangible assets into portfolio construction will be a very exciting element of tokenization, in my opinion.
So I want to dig into this access point a little bit, because you touched on access for emerging markets, non-dollar players for dollars. In a previous life, I ran emerging markets trading for Barclays, and what I think you have to split access into two categories. So there's the non-U.S. and the U.S. investors. So in Argentina in 2019, they put on capital controls, and for 5 years, they saw 200% to 300% inflation or more. So just access to a stablecoin is more than enough, right? Getting 5% on top of saving 300% in buying power is incremental, is meaningless, right? So when we talk about access, let's dig into the use case for stablecoins in emerging markets makes sense. Let's talk about the U.S. use case about giving them giving a certain portion of the investing population access to things they don't have right now.
Well, I mean, from a certain perspective, I think it fundamentally changes the types of vehicles that exist. If we think about illiquid vehicles like a hedge fund, you know, it's conceivable to now picture a hedge fund that's tokenized that can trade at a premium to NAV. And not only can people have access to it, but they can redeem on demand. And I think it changes what access to a liquidity means. It doesn't, you're no longer constrained by illiquidity on long time horizons. You can value things as a function of their underlying risk without the time horizon risk.
Yeah, I think it could also allow you to access certain sectors that you find interesting, but from a different angle. So for example, AI is very top of mind, I'm sure, for everyone right now, and you know, everyone is talking about energy as a bottleneck. If there is ability to tokenize, you know, solar farm revenue, or the ability to tokenize, or to lend against someone who's building a nuclear reactor or some off-the-grid energy solution for data centers, that would be another way to participate in the yield for the growth of AI. And so there are, I suppose, within the US, the use cases would be, what are sectors that people would want access to, and are there other ways to cut into those sectors?
I would also think of it almost like from a DeFi perspective, that if you have a basket of tokenized real-world assets or crypto-native assets that you can use as collateral to turn it into a yield-generating kind of next effort, that's an unlocking of a person's or of an organization's capital to generate returns that weren't easily done before without tokenization.
Yeah, I'll finish this access point with, a lot of projects I talk to are trying to give people access to products that they wouldn't have under the U.S. investor protection. I think that if that happens at scale, I think there's a bigger chance of heavy regulation forcing the industry backwards. So is there anything that you see in the market right now that the only real use case is to get people who probably shouldn't have access to certain products? Like when you talked about this hedge fund, right? How does the person know what they're even buying, right? How do they and just because you have $1.5 million doesn't mean you know any more than the kid who's spent 20 hours on it. So like, how do you balance that?
No, for sure. I mean, it has to be incremental in the sense that it's only going to be available to accredited investors, and it has to comply with existing regulation. But I more meant it in the sense that you have access to a different type of vehicle that you perhaps didn't have the same sort of flexibility with before. And you also get access to the blockchain rails. I think part of tokenization is merging the off-chain world and the on-chain world. And there's a lot of efficiency that comes with that. And I think if you can bring that to blockchain rails, things like automatic dividends or automation can come into play and can put some risk sort of parameters around some of those concerns that perhaps before there was no way to actually battle. There was no way to answer those concerns.
I would also add that this is an iterative market development, and I think that a firm like S&P Global can play an important role here. So when you're looking at, you've got access to these assets, and the buyer may not know anything about them, but you have a trusted third-party provider who does risk assessments and tells you, based on 120 years of history, what the credit loss potential is of a particular structure. And then on top of it, we do an operating risk evaluation or a non-rating risk assessment so that you as a consumer can have a lens of transparency of risks inherent that then can inform your decision making, that then leads to kind of pricing and price discovery. So I think it doesn't all happen at once. There's going to be building blocks that get put in place, and I think that we are going to be one of those important building blocks to do that.
So the next section we talk about is obstacles, and maybe I'll just start with the biggest obstacle. The first three biggest obstacles is liquidity, right? So how do you think we address? I would split it into two parts: the equities and non-equities, for a reason.
I have a bit of a controversial question here. what will it take for stablecoins to receive FDIC insurance? Because I think that that is a huge barrier to tokenization volume from institutions. That FDIC insurance, that safety net.
I mean, regulation, right? Like, I think that, but I don't feel like we're heading in that direction through the current path of Genius because, I mean, listen, banks are rent takers. They've been taking a lot of rent on net interest margin, and they're not going to go down without a fight. So I think, should it happen? Absolutely. Will it happen short term? Probably not.
But also, when you think about, like in a stablecoin case, there's a part of the evaluation we do is the ring fencing of the assets and the validity and security of the assets that back the one-to-one mark. When you put your money in a bank, you don't have that. Like, you're taking the credit risk of the bank, and you get your FDI insurance to help protect mom and pop depositors who are also known as voters, to protect them against a bank failure where they would lose all their money. So so banks don't ring fence it like that. The ring fencing is provided by the FDIC to try to cushion the blow for mom and pop voters. So it's a really different paradigm, I think, to compare use cases and protective mechanisms around stablecoins versus bank deposits.
Yeah, I agree. I think in a lot of cases you do get a little bit more transparency with crypto. I suppose with the FDIC example, it feels like, is that the biggest blocker, though? I mean, it seems nominal, right, for a large player.
Yeah, I mean, it definitely seems nominal. It's just with conversations that we've been having with portfolio companies, they are seeing pushback on the amount of risk that these institutions are comfortable taking. And maybe it's a function of getting comfortable with the ring fencing. Maybe it's just a function of time. I'm just trying to see, what can we lean on? What can we piggyback off of to get that comfort today?
Let's dig a little deeper here. Let's talk about equities. You have trillions trading a day for free. Not really free, but headline free. What's the point of tokenizing?
I personally think the play for equities is in the portfolio construction, as in a multi-asset portfolio, being able to integrate tokenized equities alongside other tokenized real-world assets or crypto-native assets. To me, that's a valuable component part of a multi-asset portfolio.
But you can do that now, right? You can get a multi-strategy portfolio from BlackRock. So why is it different having it tokenized?
Yeah, because you can't do it with crypto-native assets, or maybe now with a couple you can. You can't do it with tokenized, representations of intangible assets. Maybe specific cohorts of structured vehicles that are tokenized. That'll be, you get access to that through tokenization. So, I mean, those are just ideas. The proof points still have to be proven, right? But those are just concepts.
By equities, do you mean stocks or private company equities?
Public stocks.
Public stocks, yeah. I think it's a really interesting question. I could be wrong, but it seems like the biggest use case for tokenized equities would be ex-US users, at least right now at this point in time. And yeah, I think we see different attempts at doing that, right? There is the wrapping equities in the appropriate structures to tokenize them. We're also seeing perpetuals created, so kind of synthetic equities as well that mimic the price action. But of course, there's a lot of downside to that. You don't receive dividends. You have to keep paying. You have to keep paying the funding rates in order to participate, and so it's not really holding the equity itself. But I truly believe tokenized equities or some digital crypto native representation of stocks is probably one of the largest things coming at us. And at least I'm curious what you all think. At least for now, it feels like the biggest use case is going to be ex-US users.
I do quite like the use case of automation, things like dividends distributions, or, a lot of the reconciliation work that is done on the back end in a manual process right now could be automated and could allow for better capital efficiency from a portfolio perspective if you are then given access to a larger collateral base. So it's a mixture of capital efficiency and automation, reducing the overhead associated with that.
So I personally think tokenized equities for public equities for pure trading one doesn't make a ton of sense to me because you already have the liquidity gap you start with is so big. But obviously, smarter people than myself are super convicted because within the last 4 months, the DTCC, NASDAQ, and the New York Stock Exchange will all come out with tokenization. So I guess you as investors, is it even worth investing in tokenized equity companies when you see the incumbents going in full force?
Well, I think there's a lot of opportunity around the plumbing that accompanies that transition, like
people they would hire to support that?
Yeah, or market-specific oracles, for example, around that risk the risk framework that you're creating, or if it's around, vault vault structures that are then more robust and can hold and custody these different assets. I think there's a whole slew of infrastructure that needs to exist that doesn't yet exist that would help support that market transformation, and it's just, I'm not sure those market incumbents are the best positioned to produce those solutions.
Yeah, I also increasingly think, I do think in terms of having access to equities and being able to bring it on chain, perhaps it would be tough to be incumbents. I definitely agree with that. But I also think increasingly perhaps it's really about who has distribution power and who has direct contact with consumers that you're trying to reach. And so from an investment perspective, that's probably what I would think about is, yes, they have the assets, yes, they have the ability to bring it on chain, but do they have the distribution power? And I think whoever investing in platforms or companies that hold distribution power is probably the more interesting thing.
I think maybe one way to think about it is if you believe that the future of markets is on chain, which I do. So 15 years ago, markets were fully off chain. We're in a hybrid model now where you have some off chain, some on chain, and I believe in the long term markets will be fully on chain. So if that's the case, tokenized equities or having equity representation on chain will be fundamental. So it's, in a way, it's really like table stakes. It's not necessarily a great unlock. It's just table stakes as part of what has to happen in that migration, a pathway towards on-chain market structure.
Perfect. We have about 5 minutes left, so I'm going to be a bit selfish here and ask specifically our VC friends over here. Maybe it's, and with all the founders in the room, what are you most excited about, either thematically or specific companies that you're looking to invest in the tokenization space?
Anyone who's bringing differentiated yield on chain, as I mentioned. I do think energy is pretty interesting. I have seen real estate tried many times, and it has not worked. It is something that I think makes sense. There's a lot of challenges to it, and so I think if anyone has insights into how to overcome these challenges, also very interesting. I have also encountered a lot of people tokenizing very creative things, anything from oil wells to shipping containers to jet engines. And so I think there's probably a lot of, I guess, like a lot of different rabbit holes that you can go down for tokenization. But I do think anything that can allow for differentiated yield for stablecoin holders on chain is very interesting right now.
I definitely want to agree with you on the differentiated yield. One of the things that we've been saying is we're really interested in non-beta to crypto yield, just because that's what's really going to keep the liquidity within crypto markets in downturns. For tokenization specifically, we're really excited about Superstate. We think that they're in a very unique position to act as a transfer agent between this off-chain and on-chain state, if you would. I'm really interested in that high velocity. So any asset that should be high velocity, but perhaps isn't, as a function of a structural constraint in the market, maybe some commodities, rare earth, metals, that sort of stuff. Also, foreign stocks. Hyundai right now owns something like 80% of Boston Dynamics. And access really has driven market expansion in the past. We've seen things like receipt deposits, coming about in these traditional markets. I don't see why that can't be a leading indicator for expansion of access to these alternative markets as well. And so that's what I'm really interested in too.
On my side, I was very anti-tokenization because I think the use cases weren't super thought out, and there was a big gap in liquidity because it's great to tokenize it, but if you can't price it and you can't sell it, what's the point? I think the biggest opportunity in 2026 is, and we've done a bit of research on this, so there's about 62 trillion US equities, almost half is owned by retail. Some of the biggest names in the Mag 7 are 30 to 40% owned by retail. And I think tokenizing public stocks in such a way that I can tokenize my stock and borrow on Aave or Morpho at 6% is so transformational for the market, transformational for our economy. I'll leave you with a funny stat. So there's 17% of US retail stockholders who have $100,000 in equity investments or more are still paying some balance on a 25% credit card. Just let that sink in for a second. If you could go to a Coinbase or a Kraken and do just like we've done with Bitcoin, one click, borrow against my tokenized NVIDIA and pay off my credit card, pay my student loans, I think that's a massive step forward. And for that can happen now because if we can liquidate those stocks in the traditional markets, which are already starting to happen, we don't have to wait for the liquidity to be on chain. Let's use the liquidity that exists and create this hybrid model that unlocks a new financial primitive.
You know, it's interesting because when you look at the promise of blockchain, I look at it as one of the main benefits is lowering the cost of capital. So that's a sleeve of lowering the cost of capital in a different avenue than what I typically would think.
The banks, this is not disruptive to banks because banks, I'm a private client in Morgan Stanley. Last year, this time, you can get 20% in DeFi when Athena was super high. So I wanted to borrow money, and they said 50 LTV loan at 11%. They're not doing it to gouge me. They're doing it because since Dodd-Frank, they have to, these loans, which are super profitable, are not capital efficient for them. Because now, on a $100,000 loan to you, if you take the cash off platform, they have to put up 5% capital. Their cost of capital is 20%. So a 10% yield, they're probably net of capital making almost nothing. So this is a product that isn't offered right now and has a huge TAM. Thank you guys, appreciate the time. Thank you to my panelists.
Thank
thank
you.
you.
Thanks for the questions.